Your brain has its own way of making decisions, and that can lead to bad money choices. Now, because we make tens of thousands of decisions every day, there has to be some kind of process, and most of the time the decisions we make are good. I mean, there's a reason the system works, but sometimes these decisions are not good for us. And that is why the mechanisms that lead to the decision-making process are called cognitive biases. And when these biases affect our decisions about money, that is when we should watch out. I went through Daniel Kahneman's book Thinking Fast and Slow and a few other articles, and I will now try to deliver it as easy and as understandable and actionable as possible for you. So in this video we go over 11 cognitive biases to watch out in personal finance. And we'll start with the confirmation bias. That is when we tend to look for information that we already believe or already decided. And to hold up that picture, we even ignore contradictory information. For example, let's say you heard from friends that investing is risky, and then you start reading those stories of people who invested their money and lost it all. And then further down the line, you keep selecting the stories you read and you hear to confirm this notion that investing is bad for you. Now, in personal finance, this can lead to not start investing in the first place. Another example would be that you already invested in something and you decided for a certain strategy or maybe even for a single stock, and you are so convinced of what you invested in that you ignore all the warning signs and you stick to that risky investment. So how can we lessen this confirmation bias? We can start to read and listen to other opinions, to see what other people do, maybe what successful people do, and also take a closer look at their financial situation. So watch out who you take advice from, because the advice from broke people will be totally different than from wealthy people. Also watch out what kind of news and channels you're consuming, and be open to different opinions, and also be open to question the decisions you already made. Number 2 is the anchoring bias. Now that is when we rely too heavily on the first piece of information we get about something. This piece of information then acts as the anchor. In finance, that can mean that we take the initial price or the value of an asset, but this initial price can be overvalued or undervalued. For example, when you want to buy a house and you have the initial listing price in your head, and then you want to stick to it even though it's not the current market value anymore. The anchoring bias can also affect all sorts of other financial decisions. For example, when you make a decision to save $500 each month, and this decision was based on the first salary that you ever had, then this first salary serves as your anchor, and maybe you fail to adapt that number to the maybe 5 raises you already had since then. It can also be that you saw a stock price at a market high, and then you are unwilling to sell that stock because you think and hope it will reach its high again. So you are influenced by its initial price or value. Now, to reduce the anchoring bias, we can just look for more information out of multiple different resources. And then we can double check if the initial number really is its true value. And then, of course, over time, we can keep checking the circumstances to stay up to date with our decision. Number 3 is loss aversion. Now, we are much more averse to losses than we are motivated to the equivalent gain. In other words, we want to avoid to lose money much more than we are motivated to make money. In finance, this can mean to avoid necessary financial risks altogether, so to not begin investing in the first place, or keeping high cash reserves because you think it is so safe. It can also mean to hold on to losing investments for too long just to not take the loss. Or it can also mean to sell investments too soon because you want to take the gain and not lose it again, even though the investment would have potential for further growth. And I want to give you a personal example of loss aversion. So a few months ago, I had to transfer my funds and my stocks from one broker to another. And I could only transfer whole shares and not the split shares. Now, split shares are like a part of a share, and they result out of a buy-in of a fixed amount of money. So if the money is not enough to buy a whole share. So I had to sell those split shares in order to close the account. And some of them were in the red. And because they were in the red, I was like, no, okay, I'll take a look again tomorrow. Maybe then the stock price went up and I can sell them when they're in the green numbers. And for clarity, this was matters of a few euros, sometimes even a few cents. And in hindsight, it sounds so ridiculous, but really just seeing those red numbers and seeing a minus there was so powerful that in the moment, I just couldn't bring myself to sell them. And I procrastinated over several weeks. So to lessen the loss aversion, I think one of the best ways is to become aware of it. This can be the first step to making better decisions. And I mean, additionally, risk in investing is a real thing. And I think we just have to remind ourselves that there are different ways to decrease the risk. For example, by diversifying our portfolio, focus on the long-term financial planning, assess our own risk tolerance because this one is different for everyone. Then set clear investment goals and stick to the strategy. And then over time, review and adjust the investment strategy if needed. By the way, I'm starting a newsletter soon where I will write about all things money and investing and money mindset. If you're interested, you'll find a link down in the video description. Number 4 is the familiarity bias, or also called the home bias. This is when we prefer to invest in assets or in companies that we are familiar with, even though it's not the most beneficial choice for us. And in finance, this can lead to an under-diversified portfolio because you put a very strong focus on your region or on your country, and by that you increase the risk and maybe you lower the returns. And this can also mean to overlook potentially lucrative investments just because they are new and we're not familiar with it yet. And to go around this one, we can just try to invest internationally and also spread over different sectors and industries. By that we spread our risk, and we can also do research and do our due diligence of new investment opportunities. Number 5 is the status quo bias, and that is that we prefer things to stay the same rather than make changes, even if the changes would be beneficial for us. Now, the status quo bias does not just appear in finance, but also in all other areas of life, like staying in the job, staying in the relationship, not entering a relationship, keeping the current eating habits, keeping the current exercise habits, or not exercising habits. If you've ever tried to change something, especially something that you did over a long period of time, then you will know how powerful the status quo bias is. Now, in finance, this can mean to not start saving money because you've never done it before. It can mean to maintain your current spending habits. It can mean to not starting investing because you've never done it. And also to stay with the same bank, stay with the same credit card, stay with the same financial advisor if you have one, even though there might be better conditions and a better service somewhere else. And it can also mean to not adjusting your investment strategy, for example, by staying in low-performing investments. And all of that together also means that we underestimate the opportunity cost. The opportunity cost are all the returns and the benefits that we could have had if we would have decided otherwise. So to overcome the status quo bias, we can just add a little bit more flexibility and ask ourselves actively, is what I am doing right now still serving me in the best way possible? Be open for other or better products, better offers, better investments. When you first create your financial plan, then you personalize it for your needs, but also keep it flexible enough so that you can adjust over time. And for that, review your financial goals and also your current circumstances regularly. Number 6 is the optimism bias. That is when we tend to be overly optimistic about our future and our financial prospects. And at the same time, we underestimate negative events that could happen and also their financial setbacks. Now, this is a big one, not just in investing, but in personal finance overall. Especially when you're young, you've just started the job, you're earning well, you're healthy, life is good. And then you think it's always going to be like this, enjoying the moment, enjoying the luxury, and it can be dangerous to not prepare. And in personal finance, this means not preparing for unexpected financial events, so to not have an emergency fund. It can lead to overborrowing, so when you take on more debt because you think that your future earnings will easily cover it. It can be overconfidence in financial decision making, when you're so influenced by your optimism that you don't realize how little you actually know. It can mean to underestimate the risk of certain investments like crypto, stocks, or real estate. And it can also mean to overestimate their returns, so to have unrealistic financial expectations. To not let the optimism take over, we can just do our research and analyze before we act, then make a well-informed decision with realistic expectations, and we can prepare for emergencies in our financial planning. Number 7 is the sunk cost fallacy, and that is when we continue investing in something because we have already invested our time, our effort, our money, even though it's not a rational decision anymore. In finance, this can mean to hold on to losing investments, especially if we invested a lot of money into it. It can also mean over-investing into a car or into real estate, especially if they had a high purchase price, and then we keep on spending more money into the car repairment or the home renovations, even though the real value of the car or of the home doesn't justify it. Now, to overcome the sunk cost fallacy, we should not base our decision on the past, so what we have already invested into it, because all of that is already gone. Instead, we should focus more on the the present and on the future benefit of the thing. We should also be open and willing to cut losses when necessary, and if it helps, you can also ask for unbiased advice from someone else. Number 8 is the herd mentality, and that is when we make decisions to follow the crowd or a popular trend, and this leads to herd behavior without making your own analysis. And in personal finance, this affects all kinds of different money decisions. That can mean spending, so overspending on trendy products or services because you saw it on your friends or you saw it in social media, and when you don't really ask yourself, okay, is this really what I want, and is this really what I need, and also is this within my financial capacity? And this is not just the designer handbag when you follow fashion influencers. This can also be wanting to buy a house because all of your friends own a house, or wanting to buy a certain car because all of your friends have the same car. In investing, this can also mean to buy an investment just because everyone does. A more recent example would be GameStop, and in the big picture, this herd behavior can lead to speculative bubbles and also overvalued assets, which also includes real estate, by the way. How to take out the dynamic of this herd mentality is, I think, also to become aware of it. So if you feel FOMO, that is the good hint that you're falling into the trap of the herd mentality. Do your research before you make financial decisions, set clear financial goals, stick to your strategy that you personalize to your needs and your own risk tolerance, and avoid following the market trends blindly. Number 9 is the recency bias, or also the availability heuristic. That means that we give more weight to recent events and information and also think that they will continue like that. And at the same time, we underestimate historic data. A classical example for this is when we read about a plane crash and then immediately afterwards are scared to fly on a plane, even though flying on the plane is still the safest version of traveling. Now, in finance, this means that we don't perceive the risk and also the opportunities from the financial market accurately. We might overreact to short-term market fluctuations, like buying in on a trend or a short-term performance, and also selling low as an impulsive reaction to bad news. And we can also underestimate diversification if we want to chase winners all the time. Now, to not be influenced by that recency bias too much, we can just stick to our long-term investment strategy. We can base our decisions on historical data, like studies where we actually learn what's working best for most people. Of course, in an investment itself, you cannot conclude from the historical performance to the future performance. For that, you should just do a thorough analysis. Number 10 is the endowment effect. That is when we overvalue the things we own just because we possess them. And in finance, this can lead to an overvaluation of investments, of properties, and of collectibles. And it just leads to unrealistic price expectations. And I also have a personal example for this. So up until a few months ago, I owned a car. And I had this car for several years, and my mom drove it for many, many years before that. So it was really a familiar thing for me. But then a car repairman came up, and the guy said, okay, this is not the only one that needs to be fixed. There will come other things within the next 12 months. And up until then, it already was a huge time investment and also money investment for me. So I looked for selling prices. And those ranged between 3,000 and 15,000 euros. And you know, this research was based on the car brand and the kilometers and so on. And then I went to a dealer and he offered me 750 euros. And I was like, what? And you know, I think because I had it for so long and it had this familiarity value and also the luxury component to just be able to hop inside and go anywhere, anytime if I wanted to, just to have this like sense of freedom. I projected all of this into the price that I would have liked to have for it. And it took me some time to adjust my expectations. In the end, I managed to sell it for double and I had peace of mind. So this endowment effect can lead to hesitation of selling investments, properties and collectibles like my car, even though it would be the better decision. And our emotional attachment to things should really not be underestimated. By the way, I also have a really hard time to selling stocks, no matter if they're winning or losing. And this endowment effect can lead to us holding on to investments that are not aligned with our investment strategy anymore, or what would best serve us and our finances. So I think to overcome it, we should just research their real value and then become aware of the emotional attachment and try to act anyway. And number 11 is mental accounting. Mental accounting is when we segregate money into those different mental accounts or categories, and those can be based on its source or on its intended use, instead of treating money as all equal. And in finance, this can affect budgeting. So if you have like these rigid mental categories that might lead to overspending in one category and underspending in other ones, it can lead to wasting windfalls. For example, if we get a tax refund or a bonus, then we see this as extra money that we can now spend instead of, for example, putting it towards our debt. It can lead to mismanagement of debt, so not giving the high interest rate debt the priority over other financial goals like starting a savings account. And it can lead to inefficient saving, for example, when you allocate your money into different savings accounts, maybe because you're saving for different goals, even though you could have invested all that money together more effectively. I personally think that we can also use mental accounting to our advantage by creating the right buckets and just do it in the right way. And to do that, we can take a more holistic approach to our financial planning and see all income and expenses as one part of the big picture. We can prioritize our financial goals in the right way, and we can also use financial tools and software to better understand our overall financial health. I hope that all those examples of cognitive biases gave you a little clarity of how you made your decisions in the past, and maybe from now on be able to make slightly better decisions, or at least more helpful decisions for you. Maybe there are also some fears that are holding you back from starting to invest. Then you can check out this video next. I hope you got some value out of this. Thank you for watching, and I see you in the next video. Bye bye.